Hello, everyone. Welcome back to episode 2 of Direct Disruption. I'm here again with JC. My name's Anthony, and yeah, we're going to jump right into it. So, May 2022, we live in Florida, and I'm a realtor actually. And when I go into my realtor resources today, I see a call to action for our state legislators to help taper and control and dampen the impact of higher property insurance here in Florida. Because as you know, for those of you that may not know, when you own a home, you are obligated to pay certain things, right? And as the value of your home appreciates, then many other costs as well. Your home insurance, your property taxes, and things of that nature. Now, since property prices here in Florida, especially and around the country, have skyrocketed month to month, year to year since COVID, people are beginning to feel the impact of those increased homeowner insurance rates, the premiums, and the property tax hikes, simply due to their property appreciating, even if they didn't do anything other than live in the home, right? They didn't ask for this to happen. Maybe their neighbor sold a few homes, and that affects like literally all the local microcosms of housing markets. So a lot of people on fixed income, a lot of people that aren't on fixed income, that are just tightly trying to budget what they're earning, right, with inflation and all these other costs and expenses at the pump. It is a real shock. And now they're trying to pass a bit of legislation and help taper it or at least reform it. And we got a call to action. I've never seen that before on my dashboard. So, any thoughts on that?
Yeah, I'm always a little skeptical when there's a call to action when it comes to legislation, especially when it comes to. I mean, not that there's something wrong with trying to taper or trying to put a cap on insurance or insurance premiums. I mean, I personally, I would love to have lower insurance, but
Who wouldn't?
who wouldn't, right? But I'm always skeptical when it comes to this call to action per se, because give an inch, they take a mile type of thing. I feel like in terms of like control and trying to manipulate things, and I'm I wouldn't say worrisome. I think obviously trying to lower insurance is a good thing in general, but how they do it is always kind of always I guess worried about that because you don't want to overreaching hand. You don't want you know um, legislators to say, okay, we're going to cap it at this, and then once you cap it at that, now there might be loopholes in which the insurance companies can come in and be like, oh, okay, well, that's fine. Are you going to cap it at that? That's fine. Well, I'm going to add the, I'm not going to give you as much services if you cap it at this. When they'll go around it and try to get more money out of it. I don't know.
Right.
I'm
Because
just speaking.
no, you make a good point. There definitely is a knock-on effect when you try to regulate something that is essentially a free market, an effect of the free
Free
market
market esque.
of demand.
Right.
Free market in terms of demand, right? People are willing to pay above and beyond appraisals for those homes, and they're entitled to do so, even though they're going to have to, they're not going to secure a loan for the full amount that they're offering for that home. The bank will only cover what it appraises back for, which is the true value of the home, including market conditions that are reasonable. Now, like any collectible, any piece of art, what it's really worth at the end of the day is what people are willing to pay for it. But the appraisers and the banks don't see it that way. Anything over $640,000 is considered a jumbo loan in Florida.
A
At
jumbo
least
loan.
a jumbo loan, no different than a regular home loan. It's just that it's considered jumbo because uh, those terminologies haven't kept up with the times of what the inflated value and demand of a home is. So it's if you look back 20 years ago,
$600,000 is a mansion.
yeah, 20 years ago, 30 years ago, 40, if you keep going back.
Less than that, probably like 15 years ago.
Yeah, now
$600,000 house. It was a mansion, like
Yeah.
a pretty significant size home with
So
a lot.
they're considered jumbo loans. So there's definitely kind of a delay, a lag in terms of legislation. Even if you're worried or skeptical about the knock-on effect of what that entails, really at the end of the day, and you make a good point. Like, yeah, insurance companies are pretty much, a lot of them, going out of business or moving out of state. They're being liquidated, and because there's so many people coming. We can only speak really about the South Floridian market, right? There's so many people out of state that are coming into these existing homes. We talked about in the previous episode that home building and construction has lagged behind since the 80s. So a lot of homes, the tendency for the home that you do buy coming to Florida from out of state is probably going to be an older home. Now, what happened in the mid 2000s here in Florida? We have a natural disaster that's notorious called hurricanes, right? And the worst one in recent memory, you had Hurricane Andrew in the 90s, and you had Hurricane Wilma in 2005, around there, and that created a lot of damage to roofs, right? So a tile roof, the typical lifespan of that is 25 years. Shingle, 20, metal, they're climbing up to 50. So a lot of people are replacing the roofs simply because they're filing claims that now in 2022, between 2005 and 2022, you're getting to that 20-year mark, and your roof, if there's nothing else, it probably has some sort of damage, and you're going to file a claim claiming it is from a hurricane that happened, prior to moving here. So all of these claims being filed at once, people just want to, cuddle up in their homes. They feel safe there. There's so much going on in the world, and they just want their homes to feel roomy and cozy. Contractors are in shortage. There's delays. Pricing is through the roof for that. But imagine all the roofing claims and other claims as people move into these homes, and like a mass exodus from the Northeast and other parts of the country here in Florida, right? So a lot of those companies, insurance company, it's pretty simple, right? You get everybody insured. They pay a monthly payment of a certain amount, supposedly fair market value for that, and be competitive with other companies and things like that also offer home insurance. But if everybody begins to cash in on these claims and win, now your reserves and your profits from pooling together everybody's monthly dues on insurance, now it's being completely just depleted. And a lot of them are going out of business. So you're right. Going back to your point about like, hey, there are knock-on effects. If you start to unforeseen consequences to try to dampen the blow of the hike of all this home insurance hikes and property taxes and things. The property tax, you can't get around, but the home insurance, these private companies that offer it, there's a reason they're hiking it up, not only because of the fair market value for property, but also because they're in trouble, a lot of them, financially. So they're becoming insolvent. That would be the best word.
And what happens then is usually what happens when smaller companies get, they become solvent or they get depleted in resources, they get gobbled up by the bigger ones. And then you have these large mega corporations
that they can take it. They can take the short-term brunt
because they have such longevity in the space or in the industry that they literally nothing can phase them. No disaster can phase them because they literally they have the funds and then some, pretty much, especially for the bigger, larger corporations, insurance corporations, and a lot of them are tied to banks anyways, so it's one and the same in some cases. Mm-hmm. Like Citibank and Travelers, that's literally one, but it's one company, and they both run two different sections of, one does banking, the other one does insurance, but it's all one and the same, kind of. They kind of mishmash it because, if you have the funds, you can.
It's easier to keep it in house.
Yeah, it's also definitely easier to keep it in house. And not only that, but if you're a bank, then you have an insurance company as well. That's another source of revenue that the bank didn't have, besides lending and fractional reserves, which that's a major way to earn money for sure. Um, but in terms of like home building, because I actually wanted to speak on that. We're actually overbuilding, and I think I spoke on this last podcast. We're overbuilding. We're overbuilding to the point where we are peaking, and now the home builders, especially in the South, most especially in the South, are backing away from building. They've stopped construction in a lot of these places because the demand isn't there anymore. They see what's happening in they're seeing what's being projected and
Projected. We talked about that in the previous podcast, that, or at least I did, about like how it's ass backwards to build after the demand is there. So if you're trying to build, in contrast, trying to build before the demand is there, or trying to project, the projections is all you have, because you're
Right.
not there yet. You're
Right.
not there to see what will change. What will happen to the interest rates? How will that make a dent? Will the points go back down and things like that? And since it's a multi-year project and there's so much money,
and there was a major delay because of the pandemic.
yeah, and also not only material shortages,
Right.
labor shortages,
Right.
and cost of construction just going up. So
Yeah.
now you're really jumbling a lot of
And
different
diesel
factors.
being ridiculously expensive. So because diesel runs most of their most of their tractors and rigs and stuff like that. So
Oh, really?
that's
Yeah.
that's also a major headwind that is causing a lot of this. They're backing out basically. They're like, well, this is not going to work. A lot of the people there's actually more homes in construction that don't have anybody that's going to pay for it. So they're building, or they have started building,
Mhm.
and there's nobody willing to buy those homes because the market's already peaked, and now it's like, well, are these home builders going to make enough money to even like break even? I doubt it. There's actually Zach, and I want to give a shout out to Nick. He does this guy named Nick. He does Reventure Consulting. He pointed out that every time there was a peak in construction building, right after was a crash, and she even showed a chart like the whole way, like from the 70s. There was a peak in the 70s, crashed. There was a peak in I want to say 87. That's when it was like a Black Monday, and like it was a major crash in the 80s. I think it was 87. It peaked and then it crashed. Same deal in. It didn't happen until the 2000s, 2008 financial crisis, when it peaked and then it crashed. So we had this it showed the chart. It's like every 2 years after the peak, there was definitely a crash, and a significant crash, not just like a little correction or anything. It was a crash.
Now, what's interesting about you're claiming that we're at a peak, which this is.
I mean, the data's out there. I'm not saying that because I'm looking around. We're like, oh yeah, they're not building anymore. There's actually like data
Here's the thing.
showing that. And RE Consulting, we're gonna put the link in the description, because if anybody is interested in real estate, this guy is like a freaking genius. Like he shows you everything. He lays out all the facts, all the data, and that's the metadata too. Not just like, oh yeah, this year we're down 2%. He's showing you shit from years, and he's giving you charts and graphs of everything that happened, when it happened. So
what I was gonna say is, it's kind of ironic that, truthfully, you don't know if you're at the peak of a market cycle until things have already gone downhill. that is accurate.
Typically,
No, it's always accurate because if you can predict the top, then if you predict the top, then it's a self-fulfilling prophecy that you're going to begin pulling out. So now you made it so. So it's kind of impossible to predict a peak. You can look for projections and indicators, but the true peak, like the legitimate peak, nobody has a crystal ball, and it's only in hindsight are people able to pick up the pieces and say, well, these were the variables, but that was the weakest one, and we know it was the weakest one because it's the one that broke first. It's like it's past tense. We're talking about like in a literal sense, not that there aren't indicators, there aren't strong indicators of different things that you're like, hey, I'm pretty confident that this is my prediction, my projection. Let alone year, let alone month, let alone day. It's impossible to be that precise in any case. That's why markets are always a forecast of what's to come based on indicators. And then like the quality of the indicators obviously matter. And then that's where you get like, the Big Short. You have people thinking outside the box of unorthodoxly, looking at different perspectives and different data points and drawing their own conclusions, because it is like you have to kind of think outside the box if you really want to see something that the majority of the other analysts aren't already seeing.
Yeah, and it's like history doesn't rhyme. History doesn't repeat itself. It does rhyme, though.
Right.
So it's never concrete, pardon the pun, but it's always going to be. It's never going to be at that very moment when you think, okay, here's a peak. Yes, it's dropping now, but pretty much for the most part, if you have all the data showing that yes, we have peaked and we see a bubble and it's definitely going to burst. We don't know when, but it is going to happen because our indicators and our data is showing that yes, this is going to happen. This will happen in the next year or two. Who knows? But it will happen just because of how everything has been expanded and how much money has been funneled in and then funneled right out. Because lack of for whatever reason, the companies are over leveraging themselves, just like every company has done. But in the past, when there's a bubble, they over leverage themselves, and then they almost panic and get out and lose half or all their company for whatever reason. But this guy I was mentioning, he actually took a short position on home builders, like publicly traded home builders. I mean, not for nothing, I know the market is completely down from what it was 7 months ago, but he took that shorter position and he's up 120 some percent. I mean, that shows that not only is the market seeing what's happening and they're governing themselves accordingly, but that there is something happening here and that it needs to be talked about. Fortunately, is not being talked about. This is not being talked about, and I feel like our platform is to talk about it because
big elephant in the room.
Yeah, it's we gotta talk about it, because if not, everybody's gonna be kind of like what happened in the thousands or tens, or however the hell you say it, 2010, 2015 era, when everything was on the floor and people were struggling in many ways. Not just
2008, 2000.
Yeah, well, that's the catalyst. Yeah, but yeah, like I feel like it's good to talk about it now, because then we can prepare ourselves for in the next year or so, or 2 or 3 years. Because I really do believe, especially in the South, where home building was was at a rapid pace. There was a lot of home building, especially in Florida, not just South Florida, but in Florida and in total, because everyone wasn't coming down here just to South Florida. They were going to the west side, Tampa, St. Pete area, going to the villages, Naples. There's a whole bunch of building going on in Naples. Like probably Naples. I want to say the whole West Coast or most of the West Coast will be, the West Coast of Florida will be in danger of a major housing crash. Maybe not so much in South Florida and Southeast Florida, but for sure in the west side of Florida.
So
I don't want to be Florida centric. I'm just where I'm only pointing out from what I know and what I see because I pay attention to these kind of things just because this is the market that I'm in.
So with we disagree on this housing crash thing. I don't see housing as being the weakest link, or actually one of the weakest links. Um, Again, like you said, we can only really talk about Florida. Um, yeah. A lot of the people that have moved here have been from out of state. They're pricing out the local resident out of their own neighborhoods, right? And they're coming from places where their home values were a lot higher than what Florida home values are, simply because historically Northeast Corridor, which is where we get a lot of the boomers and a lot of the older generation people that are now retired, um, there's industrial centers that you want to be close to, commute to, and then you have the demand for housing in those areas just go up through the roof, just like they now we're experiencing down here, even though it doesn't feel like the homes are really worth that much, right? But because of the proximity to the demand, so it is. They're coming down here. They're not all paying cash, but we have to look at the quality of the offer that's being accepted out of dozens of offers that are being submitted on a home. The best offer, the most tantalizing offer, the strongest offer is usually the one that beats out all others. So the highest bidder, if they're not paying cash already, they have such a strong financial background that they're able to cover the distance between the appraisal and what they're offering to buy the house. Maybe they waive their appraisal insurance. Maybe, they just want to beat out the other guy because they're tired of looking around. They get rejected a few times. For other home, there's literally dozens of offers on a home, and then only one person obviously can get that home. So the quality of the loan as well is substantially different than the ones from 2008, 2009. Then also just the financial leverage these people have to come into the home is so strong that they're winning it from 39 other people or 19 other people, and they're not going to default. Now, will there be people that default? Will there be people with a fixed income that just can't stand it anymore? They move to North Carolina, sure, or become homeless. Middle class is dwindling. It's like kind of that gray area. If you're lower middle class, maybe you don't qualify for the low income programs, affordable housing, but you also don't qualify for regular housing just due to the market, right? And again, legislation, all these other things that maybe they do have a knock-on effect, but they lag behind of the real-time situation. So like change is really slow, and that's intentional.
Well,
so
it's more reactionary than proactive. It's more reactionary.
It's more reactionary, yes. So yeah, there aren't people implementing things for a potential problem. They only implement it backwards when there already is. And I mean, that's not just in the US, that's usually how governance works. And it's intentionally made slow. So there cannot be this massive upheaval where one guy comes in and just changes everything overnight. That is kind of the checks and balances of the gift and the curse of slow legislative change to ideally improve situations for everyday people. But anyway, so the quality of the people getting the loans it's on average a lot higher than what you would have gotten from 2008, 2009, where maybe your dog could have even gotten a house in their name. You don't need any proof of this or that or the other. And there is a new market with it's a small market, but it is emerging and growing over time, called non-QM loans. And these are, they make up 20% and under of all of the regular, of all of the mortgages that these companies lend out.
QM meaning?
I believe is qualitative or quality mortgage, non something. I forgot what the acronyms stand for. I'm not really good with acronym, but if you Google it, non QM is like it's outside of the conventional loans. It's meant for people that are freelance, people that are traveling nurses that are making a lot of money going around. And I know you're gonna have your opinion on that. That's fine. But instead of submitting tax returns, you show your bank balances. You show that you're able to have proof of income. It's just to offer more flexibility in order for people to not be pushed out of the traditional framework of getting the mortgages. Now, I open the floor to you about what you think about non-QM loans, but that is a real thing.
I've never heard of that, but
It's
that
growing.
sounds
It's growing.
like it sounds like another way to just call it an adjustable rate mortgage.
But it's not an adjustable rate mortgage.
It's not, or
It's
a
a
variable interest rate.
No. No,
All right, we're gonna have to Google that because that one's a tough one. 'Cause I mean, I don't know the actual
You're
definition of it.
qualifying for you're qualifying for the same home. You're getting the same result.
What's
It's
the
just-
interest rate on that in a loan like that?
Well, it depends on what your financial background is. Yes, it's going to be instead maybe a 5% will be 7.
Okay,
No, I'm not
so
a mortgage lender, but you're going to.
I hear
The
you.
main thing is not the more. And this is something I heard from these expert mortgage lenders when they gave us our our little presentation for our
Mortgage.
group. Hold on.
Okay.
Interest rate is not the most important thing. What is the most important thing is your monthly payment. What are you comfortable paying per month? That's what it is. It's not about the interest rate per se. The interest rate is there to try to get the country back in order from the Federal Reserve and Treasury. They play around with the numbers, but at the end of the day, the interest rate is not the defining factor for somebody with a good quality financial background to take out that loan. It is what they're able to afford. What is their debt to income ratio? I hate the acronyms. DTI, DPI, whatever it is. Debt to income, right? And there's a certain percentage that they're going to vet you for and make sure that you have enough money for that. And then also people just, especially if they're making money independently, which is a growing sector of the labor market, a lot of people, for better or worse, allegedly don't declare all their income on their taxes. So they may be making more money than what they're able to prove through their IRS, tax returns and things like that, and their W-9s or 1099s or all that stuff. So this is an emerging sector. Now, what is the risk? The risk is that, as it seems to me, you are trying to offer flexibility outside of something that has been outside of the traditional mortgages that are, let's refer to them as the 80% of mortgages that get done here, at least with this company I'm referring to. Let's refer to them as classic mortgages. There's a reason they're classic mortgages. There's a reason there's your FHA and your conventional and your VA and all these other things, because they're time tested to actually have the right benchmarks in order to qualify for loans, right? They're traditional because they are in a way future proof in terms of trying to make sure somebody can afford to take out this loan and to qualify for them for it. So that is the risk. The risk in my view, again, is just that it's an experimental type of way of approving people, but it's a necessary way to at least explore if you're the mortgage lender, because it's becoming a giant part. It's becoming an increasingly big part of the population as people's their work to life styles, their work to just their
work-life balance.
Work-life balance. Thank you. Remotely, this and that and the other, which you deduct from your expenses. If you're a gig economy worker, there's bartenders that make more than somebody with a fixed job, and does that mean they shouldn't be able to qualify for a mortgage if they really have the money? So that's the point of the non-QM. And if you think of it from a mortgage lender's perspective, if you don't do them, now it's about a fifth with the company I refer to. I'm not going to mention names, but it's about a fifth of the business they do. So now you're just going to take off the table 20%. And these are mortgage lenders that work with the bank. So they're essentially they're brokering again. Their mortgage loan originator. They're brokering the exchange between the bank. They have the partnerships, the affiliations, and they're able to shop around for the right product to meet your needs, so you can get the home you want. So if they don't do that, and it is growing, the best they can do is just make sure these are quality individuals, and if they're not, have them seek out rent for the time being.
So I mean,
It's all my opinion. I'm not a mortgage loan expert.
I'm sorry, like, to any mortgage lender out there, but I mean, they're
Oh,
just,
if they're watching, I mean,
if they're watching, I feel bad for you for what I'm going to say, but not really. You guys are just glorified salespeople. They literally are trying to sell something so they can get commission, so they can get their money in, so they can get. This all sounds predatory because now they're taking advantage, or whatever. They're taking advantage of the person who's an independent contractor who
but
if
they want the home.
hold on, but if they were to go to a conventional loan, they couldn't get it because they don't show proof of a fixed a W-2 or whatever. So, but they have cash on hand, or they have X amount of dollars in their bank account. So they're looking at, okay, yeah, you can afford this loan, or this kind of loan, but I'm going to get you on a 7% interest rate. Now,
That's the price of business, though, right?
of course,
That's why
business,
the monthly payment is the most important.
but
If
the
you're not
monthly
willing to
payment
do
does
it,
not
then
give
don't buy.
the monthly payment is just like how a car salesperson is going to sell you a car. How much can you afford monthly? Oh, about $300. That's not where you should be looking.
But here, I'll let you finish first.
That's not where you should be looking at when you're looking to buy a home or looking to buy a car. You should be looking at how much is the shit worth. Is it worth X amount? Yes. Is it worth X amount plus this kind of interest rate? Well, shit, man. I don't think it's worth $600,000 when it's or I'm sorry. I don't think I should be paying $600,000 loan when the house is worth $500,000. Like, we had to.
You're not going to get the $600,000 loan because the appraisal doesn't come back for that amount. Then you're not going to get covered for that.
I know loan to value,
yeah.
right? But the loan to value is based on the price of the home, regardless of the interest rate. The interest rate is basically what
but
the mortgage is.
The loan is for the appraisal amount always. It can't be what you're offering. So you have to cover that.
I just
hard.
don't feel like
you have to cover it hard. You have to cover it. No loan.
I just feel like that sounds predatory to me. I don't know the actual details. I don't know the actual details because I don't know what this QM or non-QM is. Non-QM, you said?
Yes.
Non-QM loan. That sounds like another way just to get people in the door so they can buy a house.
That's literally the point of a mortgage lender. Well, the point is to offer unconventional means to prove that they can. That's it.
That's just getting people in the door, though. That's just getting people in the door. Like, that's
people want to buy homes, and if they're not
people
earning,
people are going to buy homes that they can't afford. Eventually, they're not going to afford.
No, it's not like you're just writing a blank check. I think you've watched The Big Short too many times. It's not like that. It's just qualifying through other means because you're not able to prove it through traditional means. Now, this would be up to the individual lender to kind of see how seriously and strict they are. But this is an emerging part, so it's not going to go away. And yeah, I mean, look, to play devil's advocate, right? If the prices are so high and the appraisal is such a gap, it often is a gap between the what the appraisal comes back for versus the offer you can make. The only people that are able to even qualify for the mortgage in that case, plus the hard cash needed to cover the difference between that loan and the offer price, it's only going to be the strongest independent contractors that are able even to put themselves in a position to outbeat everybody else anyway. So again, remember, going back to what I said before, that if you have 40 buyers, the strongest one will get it. So whether they're independent contractor, whether they're salaried, whether whatever, they're able to do it, they're going to get it, and it's always going to be the strongest one. Now, does that come with a risk on behalf of the homeowner that, hey, maybe bartending doesn't go well for me 2 years from now. You know, oh, I was making a lot during COVID. A lot of people were drinking at the spot, but they opened another spot. Now my tips aren't as much. Now the consistency isn't there. That is a risk factor, major risk factor. Like, oh, I'm a YouTuber. I was making a lot of
So
money.
you can see what I mean by it sounds a little predatory because they're going after these people that are independent contractors.
But they're not going after them. They're being solicited by the person that wants the home. That's where like the predatory thing doesn't make a lot of sense. You're not trying to get them to get the loan. You're offering products because they want to get the
a
house.
salesperson looking for a commission is always going to find the person that they need to make the commission.
But they're not finding them.
There's
not going after
people
them.
out there, and they're looking for it. I'm sure this kind
They're
of
not
loan they're
okay.
looking
If they're
for
the
this.
mortgage
They
lender,
wouldn't make it if there wouldn't be a demand for it or a
that's literally how markets function. If there's a
I'm
demand
aware.
for it, you make the product that
But-
they want. But the difference is, instead of putting up a Facebook ad like, "We'll just qualify you," blah blah blah. The mortgage lender is not knocking on their door. They have enough business as it is. The buyers coming to their door
Well, they're
saying,
getting less
"What
business now than what they were 6 months ago.
now?"
Now, and when did
Yeah.
this non-QM loan start to happen?
I couldn't tell you when it started. I just know it's a thing and it's growing. But the difference between a predator actively seeks out. Okay, if the buyer's knocking on the door of this office right now and saying, "I need to qualify for a home," I feel bummed out. I don't qualify for a conventional one because I'm not able to prove the conventional
Well,
stuff.
good thing for you. I have this other offer here. Maybe you should take a look at it. Maybe it'll benefit you and your family.
But the buyer assumes that risk in the worst case
Buyer
scenario.
assumes the risk. Of course, the buyer
No, I'm
assumes
saying
the risk.
in
And
the-
if they're looking at it in a form of, oh, I can afford monthly payments at $1,000 or $102,000. I'm sorry, what am I saying? $1,200. If I can afford $1,200 mortgage on it every month, great. That's fine. I'll do it.
No,
They're not looking at it. They're not looking at the whole pie. They're looking at how much I can take. I can put in to minimize every month. I can just put this amount. I'll get to 30 in the 30 years. Whatever lifespan of the mortgage is. I don't know how long those mortgages are. I would assume 30 years because
It's the same thing.
so
Tiny
they got
interest
15 or
rate.
30.
Tiny interest rate hike. You're just trying to get to the same solution a different way. But let me rephrase it the way I said that the buyer assumes a risk. Let me rephrase it. I mean to say that the buyer assumes a risk in the scenario that you're paying, right? If you're saying that it is predatory, it's not like somebody's putting gun
Like
to
I
your
said,
head.
it
and saying-
sounds predatory. Because
Sounds.
again, I don't know what this actually entails.
I
what's the
understand. I
details on
understand.
it,
I
so
understand. Also,
I don't want to
like-
sound like I'm talking out of my ass either.
So what I mean by the buyer assumes the risk is not the buyer assumes the risk of defaulting. I mean, that's with every mortgage. You don't make your payments, that's on you. But
sure.
I'm saying if somebody doesn't qualify through traditional means and there are these products being offered and they are insured and they have the mortgage insurance and they're arriving at the same result with the same amount of security, at least in terms of the quality of the loan. Which is, I guess you could say, well, it's not the same quality if it's not through conventional means because you're not able to prove this that you would need on a conventional loan. Okay, so that's arguable if it's of the same quality through that paradigm. But if you're arriving at the same result and this person is making the money now, if they're not able to sustain it later, that is not the lender's fault. Because, and this is why I said it's a risk factor. I'm not saying, oh, it's not risky at all. What I'm saying is the quality of the loan inherently is not the risk factor. The risk factor is the reason why you need a non-QM in the first place, which is because you don't have the sustainable, steady income. You may be a YouTuber now, and you may make stupid money, and I've seen this happen. People that are just nice people, honest, and they say, look, I'm just not making as much. Here are my numbers. Then 2 years later, they figure out like, oh, I can't do prank videos anymore. It's getting stale. My retention is not there. Now they're screwed out of that.
Mm-hmm.
But
And what happens?
What happens?
Yeah.
What happens is that
They try to
There's-
sell.
they try to sell. Yeah.
And they're going to sell at a
Loss.
loss. Thank you. So with that being said, that just shows.
I'm just
that this
putting
is
the
not-
risk factor more on the buyer than the mortgage lender.
I
That's what
hear
I'm
you,
trying to say.
but why make if you know the if you know that it is potentially a risk, a significant risk, why give out the loan?
Because it's a growing part of the population, and
Because
you're not
they're
going to avoid it. You're not going to avoid it.
They may not avoid it, but
It's increasing.
they're still using that to their advantage. Hence why I'm saying that this sounds like a predatory situation.
Now, here's the thing: the
This is-
non-QM is becoming more prominent during the COVID years now because of
Yeah,
you're trying to find every competitive advantage to, first of all, just be able to submit an offer that's worthy of being accepted. That's, at least from this presentation I've received, that's the sentiment I got. You need more tools in your tool shed in order to prove certain things. Maybe you do have a salaried income, but maybe you're having additional that maybe is not strong on paper, but your bank statement says something else. So it's not just we're just going to trust you and put down your income here and we'll see what happens. I think you'll have a good chance. It's proving things through unconventional means. Maybe you have some conventional stuff on top. Maybe you're seeking out a best interest rate. Maybe you're seeking out to just get the more, there's a million variables. Maybe you're just seeking to get the home now. You're banking on the equity will go up in the future. Kind of a hot potato situation at this point in 2022, right? Because something has to plateau.
Mm-hmm.
And the interest rates aren't going down this year at least. But maybe you're looking to at least secure the home now. You need it immediately. You've been rejected a few times, and then you're looking at refinance down the road. That's always an option. That's always an option. Now, this is assuming that you're responsible enough to, come back in a timely manner, refinance, or even if you're looking to get the equity and move on from that because you're assuming that it's just going to keep increasing month to month as it has been the last 2 years. If you're responsible enough, you're going to be able to pull something that would be of a greater value than when you originally took the loan if you're responsible about it. It's insured the same ways, it's just through unconventional means. So like when you say it's risky, is it risky to offer it? I think that's more of your argument. Like, hey, should you be even having this on your business balance sheet, like as customers?
The fact that they're making these so they can cater to that demographic of independent contractors, right? They're catering to that. They're giving that to
It's
them.
still a minority of their business, mind you.
Of course, 20-15% of it. That's fine, but that's a significant chunk. Whether it's conventional or non-conventional.
Now you said they're doing less. You're assuming that they're making less business now because the housing inventory is so little. Well, if you're in business, what do you do in order to increase the amount of potential customers you may have?
You try to get
loan offering.
Of course, yeah. So then now you're looking for, okay, well, there is a certain demographic that doesn't have a regular W-2 job, but they do have income now. Let's go. Let's see.
Good income.
We can.
Also, you can do. I'm sorry to interrupt you again, but also you can do prove things through assets and have that as collateral as well. So that's leverage as well. So that puts you in a better position. It's not just like just the bank statement. There's a couple different ways. That's why it's, again, unconventional means. It's just that your pay stub is not showing it. Maybe you already have some assets that can lower the interest rate or get you in a better position because you're showing, hey, look, not only do I make this now, and I've been making, for example, there's people that don't work, especially with COVID, at the same job for the last 2 years. Now they're just, in a conventional sense, they're put in a bad position to take out a conventional loan. They're between jobs. Why? Because the whole entire global economy and the way we work has been abruptly disrupted, directly disrupted, and they're just not able to prove the consistent employment for 2 previous years. It's not just your bartender; it's just people that, not the world has been flipped upside down, but they are in fluctuation with the rest of the world through no faults of their own as well. Those people fall into the non-QM category as well. So it's not just. And I know why you're thinking what you're thinking because it feels like deja vu. Oh, we've been there before. Oh, so you want to qualify people that wouldn't normally qualify? Red flag. Got it. But it's just a different market as well, where it's just really hard to get a home, and some people just need some other competitive advantage that's not conventional, and it's still a minority of the business. It's so you don't, and this might be actually in your defense of, oh, that sounds predatory to me, but it is in the defense. It is in their interest to not turn away somebody that doesn't think they qualify just because of the conventional means, right? You don't want to turn away somebody that does have the money, that does want the home, and now all they're missing is you, but you're over here like, sorry, I can't take that risk, and you're like, now I've lost customers. Now you need to, but we have other options.
What is a mortgage broker? Like I said before, that I think they're glorified salespeople. They are the broker. All they care about is the commission.
They're business people.
They just found out a way to make commission and to also provide loans to people that they may or may not be able to afford it down the road, but they don't care because they got the commission. That shit's on the bank now. It's not on them.
I have a question. How's that different from like all of these ridiculous 0% APRs with car salesmen?
Well, those are like I said, they're glorified
Business-
salespeople.
No, I'm just trying to confirm. So
Well,
you see no difference between that.
I've seen no difference. No, like that's just a sweetener. Like, okay, yeah, well, zero interest for a year or 2 years, and then 11 to 24% after that.
And not
No
knowing
difference.
what will happen
And
down
not
the line,
knowing-
maybe you'll
yeah,
trade it
Because
in.
they may be traded in, but you can trade it in. That's a little bit different because the car depreciates as soon as you get it out the lot. That baby's not going to be worth shit after in those 2
Yeah.
years. But a home, this is going to be different because this is you're pricing the home at its peak, and you're pricing its home at its peak with the current interest rate or whatever interest rate they decide to put on there, and then you think they're going to be wanting to refinance that later down the road? Probably not. Not that they may want to, but they may not be able to because it's going to be more expensive for them to do that because they're going to get it. They're getting it at a loss.
So the contrast is,
No matter if the interest rate goes down later on. So if the interest rate goes down to say three basis points, whatever. I'm just throwing that out there. That's not even right. What am I saying? Like 100 basis points. It goes down a significant amount. They're able to refi, but then when they refi, they realize, oh, I still owe $100,000 on my home because my home was worth much more than it is today.
So the contrasting element of cars and homes, I mean, that's pretty obvious, right?
That's clearly obvious.
Short term depreciation and long term, unless you have like a classic car or whatever. which
Don't
is
get me
rare.
started on because now what they're doing with these car loans, they're having 8-year, 10-year car loans on these the terms on the car loan. So like it used to be like 64 months at the most, which is like 6 or 7 years. Now they just ballooned it now to like 10, 12 years because people are gonna be like, oh well, you think you're gonna hold a car on for 10, 12 years? Most likely not. Not especially the quality of these cars nowadays.
So the contrasting element, obviously, with cars, short-term and long-term depreciation, and a house may depreciate short-term in terms of the value of it due to market conditions, but long-term appreciate.
Oh, long term, yeah. If you're
But-
holding it for 30 years, luckily, if you're lucky to hold it,
even if you're not holding it for 30 years, even a 10-year period, if you can ride
Right,
out the
yeah.
wave, you're probably going to be okay.
Yeah.
But that wasn't the aspect directly that
But
I
we're
was
talking
addressing.
about the human aspect. The humans aspect.
I was talking about
the
the financial aspect of flexibility, financing,
Right.
like how these two seem, at least in your view, to seem like two cuts of the same cloth, right? Whether you're a mortgage
in a
lender
sense, yeah.
or whether you're a car salesman, you're just trying to get a deal done. It's up to the customer to determine if they're, make sure that they don't have any abrupt changes in their life, that they can continue payment. But
The mortgage broker or the car sales broker, whatever the fuck they're called, they're just there to they're literally the middleman. They're looking, okay, can you afford this now? Okay, good. Have you been able to provide a certain amount of income statements for whatever the time allotted? Fine. Yes, good. Okay, now I'm going to take that. I'm going to give it to the bank. The bank's going to say, okay, good. We sign off on it. Here you go. Here you go, Mr. Lendy. We're going to give you this loan. Here's a loan. Have a nice day.
Yeah, I mean, it's kind of yeah. You would categorize it for sure under sales, but
They're
there's
just
not.
looking. They're just looking for their next commission.
But guilty as charged. You
They
know that
may-
is sales.
I'm not faulting them for doing that because they need to make sales. There's nothing wrong with that. They need to make money. That's fine. They need to eat. So do everybody else. But
There's still supposed to be these non-QM quality loans through unconventional means. I keep repeating that because that is the alleged purpose of them, to give you a quality loan that is secure through unconventional means that are arguably less secure. But again, that's based on the
I feel like if you,
fluctuation of the buyer's life. What are you gonna do?
I feel like they're looking for an angle here. They found the angle that works for them.
And most
It may
people
be
aren't getting
15
the
to
home
20%.
anyway. So like if you're a small fish in the offering pond of bidding on a home, you're not even in the conversation. We're talking about people that may typically they just need the extra inch. Oh, I just my job says this, but my bonuses aren't factored in because maybe this season ended early or it's part of next tax season. But like the bonus is every 2 years really, but I can't prove it there because actually with COVID I got and it becomes that story. My thing is I kind of can't fault the lender on any of this because it is
The lender or the mortgage broker. There's two different parties.
the lender and the broker, the mortgage lender and the actual bank that lends the actual money.
The broker underwrites everything, so they're the ones that make the deal happen, and on
I'm
whatever
talking
terms.
about the parties of the mortgage lender, whether if you're looking at it from the top down, your mortgage broker, your originator is usually the same person, the broker, and I'm talking about the processor, all of that party, the bank that they're connecting you with. It's kind of hard to fault them for basically doing their job. And in this tough time, like you said, yeah, it's true. There aren't that many homes on the market. So you do have to pivot. You have to pivot. And going back to tie full circle with the insurance companies, the ones that didn't pivot or that weren't prepared, which, maybe it's impossible to be prepared for COVID or something like that. But all of these claims, like you said, the over leveraging of the business, not being able to really have the money back of every claim that could potentially come in, that is ultimately what leads to a business failing and being insolvent. And yeah, the mortgages are very tricky in of themselves, and it's a huge life decision. I think your thing is like you're putting a lot of importance also on what they're getting the loan for. It's a home. The market is kind of at its peak and plateauing, and it's such a long-term thing. It's a commitment. And it is. I think your point is definitely coming from the base camp of like it's irresponsible to prove people that are able to prove what normally should be proven in order to qualify for this type of asset. It's like if I buy a company, I'm like, hey, buying a company because I'm making a lot of money on YouTube. I just want to buy you out. Don't have all the money, but I will find somebody to give me the loan to give you the money. So hand me the keys to the business. And it just kind of feels like, in your sense, like it's not as substantial as it should be. And there's a fair degree of hot air within that and risk factor that's like, whether it's the lender being irresponsible by offering it in your view or the buyer willing to take it, seller's happy, they don't care. But it kind of, I think where you're getting it adds a degree of unhealthy uncertainty to an already precarious situation that we have in the economy. For this to just kind of be like a new offering.
Right, because they're looking for desperate people. They're looking for desperate people who can't get a conventional loan, who can't even,
Everybody that wants to buy a home is desperate in this market. To
Right.
be fair,
So
to be fair.
when people are greedy, be fearful, and when they're fearful, be greedy. So if they're
I see
looking
what
at
you're
that
saying,
way, I feel like this is why I say this is like predatory, because they're just looking for an angle. They're looking for an angle so they can get more sales, more commissions. This is just another way to skin the cat, if you will. They're looking for desperate buyers. That can't get an FHA loan, and they can't get a conventional loan. So how about this? Like, why not this? This may work for you because of your credentials and how much money you have in your bank account.
Yeah, I understand where you're coming from. I'm not even necessarily disagreeing with you. I'm just offering different points of views because neither of us are experts.
And this is on the mortgage broker that is brokering these deals, because they're underwriting. They're making these stipulations. They're the ones making the stipulations and the terms for that loan, and the bank is agreeing to those terms.
Yeah.
So I'm sure there's a lot of kickers in these terms, because they're not just going to give it to you just because you have $100,000 in your bank account. And if
Sure.
you try to, let's say you try to refinance, maybe they have like a kicker on there or a contingency where as soon as you go for a refinance, it's like a due on sale clause type of thing. Like, I mean, obviously it's going to be, if you're doing a refinance, the whole amount is due. So if the refinance is less than what you're getting, or less than what the actual loan is
From before. Yeah.
you're fucked. You still have to pay that shit off. So
So on that note, well, thank you guys for watching. Thank you for hanging around for episode 2. We look to make this a long-term deal. So we'll be here. It's up to you if you're along for the ride. Feel free to subscribe, share it, like it, or comment. Maybe we're both idiots in your view and you should offer a differing opinion.
most likely not, but
We welcome that too.
yeah,
Opinion. So yeah, hey, it was a good conversation. Thank you.
yeah, man. We'll do it next time.
Yeah. See you guys in the following episode. Thank you. And if there's any topics you want us to cover, let us know. All right. See ya. Have a great day.